Welcome to the Smart Money Core Concepts training. In this video, we're going to be focused on liquidity, helping you understand what liquidity is, how to identify areas inside of the market, the different sorts of patterns, manipulations, and key timings that we might see liquidity grabs. Now, liquidity simply refers to the money that is inside of the markets. You can think about it from the perspective of how quickly can an asset be bought or sold without large swings in price. If we have a high liquidity environment, that means it's going to be easier transactions and less volatility, whereas low liquidity can lead to price manipulation and larger movements. Think about all of the buying and selling that happens every single day inside of the markets, because that is just the beginning of understanding liquidity. See, we also need to consider the pending orders that are waiting to be executed and actually entered into the market or taken out of the market. So this is going to include the buy limits, sell limits, buy stops, and sell stops. Like we reviewed in the video about order types, limit and stop orders do not only represent potential ways of entering trades, but you can also consider them as your stop loss or your take profit orders. So when there's a large cluster of orders that form in a particular zone or around a significant price level, this creates what is called a liquidity pool. These pools are often targeted by institutional traders to trigger and capture liquidity in order to give them better odds of having their entire trade filled. So now that you're aware of liquidity pools, you're probably thinking, where is the money in the markets? How can I spot it? So let's take a look at a couple of examples right now. First up, we have silver on the chart. We're looking at a monthly time frame, and if you're like me, the first thing that you probably notice is that nice clean level of support. You can see that price came down, it made a low, it had a little bit of a bounce, and then slowly came back down to touch that level one more time before arriving at where price is at the time of this screenshot. Now, below those lows rests liquidity, a combination of potential buy limit orders for traders that are looking to enter the market, a combination of stop orders for traders that may already be in buys that have their stop loss set at or below the low. And we also have the possibility of traders that are looking for a breakout if they had the bias that the market was going to be moving lower. So we can look at that as a liquidity pool below those lows. Now watch what happens. Price ends up trading through those lows and creates that very long wick that you can see. Notice, however, that the body of that candle came all the way back up, and it actually closed right at that level where the support was created initially. In the months to follow, we can see that the price of silver actually rose exponentially. So this right here is a really great example of how runs on liquidity can work. We get that initial price action followed up by the manipulation, and then we see an explosive movement in the opposite direction. Now let's take a look at another example. Right now, we have NZD USD up on the chart. And we can see pretty clearly that there is a trend line that has been formed over quite a bit of time. Every time that the market comes up to that level, we see price trade into it, maybe a little bit of the wick goes beyond it, and then the market ends up reversing and going lower. So, what might happen this next time that price decides to trade up and into that area? Well, let's see. Going into the hourly time frame, I've annotated a couple of things on the screen. The green line represents that weekly trend line that we were looking at initially. At the bottom, we have where the week started off, so the weekly open price. We can see that the market ended up going up and into that trend line. After a little bit of time, it created what looked as if it could be a level of resistance. And then we see price actually go up, run through the liquidity. And after that liquidity grab happened, we see some imbalance created. The market comes back up one last time to test it. And then we see a sharp reversal that happens at the NFP news event, bringing price all the way back down, lower than where that week started. A really great way to think about the type of manipulation that we could see is that if it's obvious to you, it's probably obvious to somebody else too. See, in trading, there are a lot of different patterns, techniques, and strategies, and some of these concepts are very universal. If you think back to some of the first things that you were taught when you began trading, it was probably similar to a lot of the things that I was taught too. Things such as trend lines, support and resistance levels. These very simple to understand concepts, but when you look at it from just a surface level perspective, without asking, well, why do these patterns happen? Why do they work sometimes, and why do we see them get traded through at other times? It comes back to the central idea of how liquidity and the manipulation that we might see inside of the markets, it's such an important dynamic that smart money traders look to understand even deeper on a continuous basis. Now, when could we expect this manipulation to happen? There are a couple of key times that we can be aware of. First and foremost, around high-impact economic news events. This includes events like interest rate changes, CPI, NFP, the list goes on. Anytime that you see one of those red folders, there's a pretty good probability that we could expect to see some large fluctuations and potential manipulation inside of price. Secondly, during session changes, such as New York or London Open, you also might find that during the Tokyo session, there are lower levels of liquidity, which result in the potential for larger price fluctuations. There's also other times, such as Power Hour, which is the final hour of trading for the day. We're going to generally see increased activity as traders are looking to close out of their positions, which can result in potential movements within the liquidity. Lastly, there is also those surprise real-world events or disasters that happen. These are things that affect you not just economically, but in your everyday life. So a lot of the time, these things aren't planned. They weren't necessarily being talked about. They just happened. And so therefore, the market, in response to that event or that disaster, is going to have a reaction. In a market where most people are blindsided by manipulations, smart money traders look at this as opportunity. Understanding and leveraging liquidity doesn't just give you an advantage, it completely transforms the way that you can approach your trading. When you think back about exactly what happens when you go to take a trade or when you go to exit a trade. Remember, if you were buying, well, then you've got to sell the position back in order to exit the markets. And the same thing is true if you were selling. You're technically executing a buy when you go to get out of the markets. Liquidity is simply money. And by recognizing the true nature of liquidity, you position yourself not just to survive in these markets, but to have a greater probability of actually being able to thrive. Trade with more confidence. Develop your insight and make the markets work for you. Because in the end, it's not even the market that dictates the level of progress